CRIF presents How India Lends in association with CNBC-TV18.
Hello and welcome to our special show, How India Lends, presented by CRIF and CNBC-TV18. Credit scoring company CRIF has aggregated a whole mountain of data on loans lent by all institutions. Private banks, public sector banks, NBFCs, MFIs, they've come out with the most interesting set of trends visible in terms of lender behavior and borrower behavior, all for FY25. The report should be useful to lenders themselves, to the regulator, and more so to the investors to understand where is loan growth, where is the pain, and where are these trends headed. Joining me on the show are the author of the report, Sachin, Seth, who also is the head of CRIF, Sudipto Roy, Managing Director and CEO of L&T Finance, Kanika Pasricha, Chief Economist, Union Bank, and Madhusudan Ekambaram, Founder and CEO of Credit B. Gentlemen and Kanika, thank you very much for joining us on this very special and I would guess a very interesting report. Let me first go to the author. Sachin, thank you very much for coming into our studio itself. First, what are for you the standout things? What surprised you from your own data?
Thanks, Latha. So first of all, Latha, every time we release this report annually, there are a lot of things which comes completely, surprising. So this time I'll say there are 3 or 4 points. First of all, this microfinance, the issue or let's say the stress which has been there, I think it has lasted much longer than anybody expected. I think every quarter everybody has been tracking and we hope that, it should we should recover from that. But I think it has lasted much longer. We are seeing some signs of improvement now, I think, as that we saw the data last month. But that's one thing which was surprised all of us. Second is that if you see the share gain by public sector banks and even NBFCs in many of the segments over private sector banks, that has been a big surprise because there has been a stronghold of private sector banks in many of the segments, including home loans, including other segments, credit cards, personal loans, etc. That has been a very, very eye-opening thing, which means that there are systemic change happening in the industry. So that's a new thing. Third thing, that the amount of focus and thrust being given by government and multiple ecosystem partners on MSME, we were hoping that there could be a lot more adoption. But I think there has been changes, or there have been improvements, but I think it's still a lot more to be done there.
Work in progress.
Work in progress, yeah. And I would say on another segment, consumer durable segments or other personal loan segments, I think we see that it's continued to be dominated by 3 or 4 players, primarily NBFC players, which is very, very different compared to other industries. So there are only 1 or 2 banks players and NBFCs are doing far better there. So that continue to be there. So I would say, in sum and substance, these are the 4 things.
Sudipto, anything, you've been a veteran player. Anything surprised you, shocked you in the findings of the trends in FY25?
Okay, maybe, the pace of slowdown in some places have been a little more than what I estimated for. So if you say that is something which I found probably a little more than my expectations. But the fact is that if you see, last year was a tough year, actually. From an asset quality point of view, last year was a tough year. And most of the lenders, right, they took up their sort of credit guard rates. And coupled on top of it, if you see from around from the latter part of 2023, the Reserve Bank of India also started upping its ante on sort of curbing the runaway growth in unsecured loans as well, right? A variety of actions. Now, when the regulator is also pushing you to sort of temper your growth charge, as well as when you have risk rising on the margin, which obviously the private sector banks with very large unsecured portfolios, credit cards and personal loans portfolios go for the first time, always. And then we saw the microfinance sort of asset quality issues start bubbling in the front from the April of last year. Overall, there was a sort of a realization in the industry that, probably, the fraud, as we call it, on top of the lending ecosystem had built to a certain extent that there was a slowdown needed.
That point is taken, Sudipto. What surprised me is not that the unsecured loans fell, because the Deputy Governor Swaminathan was telling us in the press conferences that 30% growth is not like, when nominal GDP is growing by 10%, you can't have a 30% growth in unsecured loans. But I was more surprised by MSME originations falling. It was a good year of growth, a decent year of growth, FY25. That surprised you?
No, no, didn't surprise me because Lata, have to understand that everything is connected, and MSME also takes unsecured loans. So the fact is that when you have one part of the sort of ecosystem exhibiting risk, which is in credit cards, and many of the MSME, especially on their personal or the individual capacity, also borrow from the market. And the fact is that when you underwrite an MSME loan, you not only look at underwrite their business, you also underwrite them personally. And when you see that their personal borrowing facilities are showing signs of stress, the guardrails also go up in the MSME lending.
Fair enough.
Right? So
okay, point taken.
I think the risk perception of the industry went up, which led to increased sort of credit guardrails across all segments, which led to a sort of secular degrowth in lending in all.
The other thing that, which I want the economist to comment from Union Bank, Kanika, the report says small ticket loans saw slower uptake and higher delinquency pressures. Whereas the borrowers seem to have gravitated towards higher ticket loans. Is this saying about K-shaped recovery? What does this say?
You're absolutely right. It is the high ticket loans that are gaining momentum. And I'll actually connect with what Sachin talked about. The reason why private sector banks were not growing as much as public sector banks, one of the key areas is home loans. And in home loans, what we found is that private sector banks' growth is less than 5%. If I look at RBI data, I'm not quoting from How India Lends report, while public sector banks' home loan growth is around 12 to 15%. While the accounts, the number of accounts growth is falling in both segments. But it's the ticket size of loans that's rising in public sector banks, because private sector banks, as the cycle started to shift towards easing, they didn't want to get into EBLR linked loans. And in fact, there's such competition in home loan market that the interest rate bucket for 9 to 11%, which had 65% share in FY23, fell to only 40% in FY25. It all shifted to 7 to 9. So private sector banks were not willing to lend there. So ticket size of the loans has shifted from private sector to public sector. And that too, we've seen it's the higher ticket size loans as part of K-shaped recovery that are growing more, while the smaller ticket size is struggling. So absolutely right. It's the shift in wealth effect. It's a shift in the income pyramid as well. And it's the bottom of the pyramid that's still struggling on inflation, while the upper end is relatively comfortable.
Madhu, to get you into this personal loan thing, Sachin's report says early stage stress showed improvement. Now, does this mean that we are in an improving cycle of bad loans because early stage defaults are declining?
Yeah, see, I think before getting into the report itself, let me talk a little bit about what we saw in the industry as such, right? So if you take Q1 of FY25, which was last year, somewhere in that April, May, June quarter, everyone saw the stress in the unsecured lending space. It could be either the short-term personal loan, long-term personal loan, or even the microfinance started showing certain stress. Now, it all depended on when each of the companies' stress kind of peaked, when did the risk peak, right? So most of the NBFCs, when we see that, it peaked by Q2 and in the results, we could see that, or in Q3, somewhere the risk was peaking, and after that, it was always improving. But the stress continued somewhere in the microfinance segment, and people say that it's yet to be seen, the peak risk is yet to come out and whatnot, but that is where it has continued as a higher risk within the personal loan segment. Now, specifically coming to, let's say, the fintech segments where we operate, I think what we saw was that the Q2 where the risk actually peaked, and after that it has been in a very much of a improving trends is, or the declining trends is what we have seen, and that's how the industry benchmarks are also showing. Something from the report, what I have seen is that while a lot has been talked about, there has been a risk that is in build up in the short-term personal loan or the small ticket personal loan. But if we go a little bit deeper and then look at it, less than 1 lakh rupee, the risk has not built up. The risk has built up in like 2 lakh to, let's say, the 10 lakh segment is where we have seen the risk has deteriorated over the time. But less than 1 lakh has always been performing well. That's what the data shows. But however, there has been a lot of narrative both in the media and everywhere else there, that anything less than 50,000 or 1 lakh rupee has been more stressful, but that's not the case if we just look at the report data, and that has been a pretty good surprising element for me. Yep.
Okay, yeah, I think an earlier report had said under 50,000, but that was an old report, so maybe things have corrected since. Sachin, would you agree, from what Madhu is saying, will we in FY26 see less stress? And I'll tell you why. The financial stability report that Kanika referred to, that gave the impression, especially for NBFCs, that stress will rise. From about 2.9%, they are expecting the baseline to go to 3.3. But you're seeing some signs of early stage delinquency falling. What is your best guess of 26? Will stress be more than 25?
If I say that, whatever we are seeing the signs, and we have also compared it with the last 2 or 3 years in certain situations. So if I stick to the segments what we have assessed, definitely we are seeing that certain corrective actions being taken by lenders. So microfinance, we are working very closely with the industry. We are seeing corrective actions, and we have, in fact, I can tell you what is not in the report. We have even taken the data of April also, and we are seeing that, there is an improvement.
Decline in stress.
Decline is happening. So we are hoping that when we release the report in June, or June end cut data, it will definitely have improvements. So hopefully that would be better. If we look at personal loans, etc., I think a lot of corrective actions have already been taken by every lender, and there is a very cautious approach. So that is being taken care. I think if you talk about certain other segments, I think people are shifting about asset-based lending and more of a secure lending. So there is a lot of talk happening on micro LAP, etc., which are by design a less sort of risky assets. So there's a shift in the industry happening towards that. And even overall lending portfolio, you see the growth which is happening is towards that, right? Gold loan also has been, the highest growth has been in the gold loan.
Yes.
In fact, if you see the portfolio growth, there has been a decline in almost everything except gold loan. And gold loan, RBI has already come out with saying that you need to have even a bureau check there, which most of the people are not doing, right? So with all this keeping in mind, I think the industry ecosystem, the guardrails, the RBI guidelines, the liquidity, the changes which have been done in the allocation for the MFIs, if you keep the portfolio as it is, I can definitely say that this portfolio will improve. But what definitely happens is that portfolio is never it's a going concern, right? I think we will definitely have improvement in the portfolio quality. There could be always a mixed bag.
Fair point.
But same portfolio, if you keep it, definitely portfolio is going to become better. There's no two thoughts about it.
This is a great point in which we have to take our first break. That we are, CRIF is expecting that the portfolio as it now exists, FY25, there is a good chance it improves. That's very positive, of course, for even listed stocks and their investors. We take a break on that note. We are coming back with more questions.
CRIF presents How India Lends in association with CNBC-TV18. CRIF presents How India Lends in association with CNBC-TV18.
Welcome back to our special show on How India Lends, a very interesting report on the trends of borrowing and lending in India in FY25, prepared by CRIF. I've been speaking with the author of the report, Sachin, Seth, who heads CRIF. We are also speaking with Sudipto Roy of L&T Finance, Kanika, the economist from Union Bank, and Madhusudan Ekambaram, the founder and MD of Credit B. Thank you very much, gentlemen, and Kanika, for waiting by. Sachin, one of the intriguing things which you pointed out earlier in the show is that public sector banks and NBFCs have gained market share and private sector banks have lost. Is this, it's a bit surprising because the secular trend in India has been private banks gaining market share over public sector banks. Is this just more caution by private sector banks because of unsecured loans, etc.? Or is it HDFC putting controls on its loan growth because they have to make up for the big loan book they got from HDFC? And so the bank wantonly controlled its loan growth. What is the reason for this?
So, Latha, first of all, I'm not qualified to comment on any specific bank. Being a practitioner in the industry for 3 decades, I can see that one thing what we are seeing in the report, but there are other factors also. I've been seeing many public sector banks driving many digital initiatives. So in fact, if you see that public sector banks traditionally, let's say, 5 years back used to take, let's say, 30 days to approve a home loan. Today they can do in 3 days. Even in MSME, when we saw chairman of public sector bank talking about saying that, in 15 minutes they can approve a MSME loan.
SBI chairman said.
Yeah. So Mr. Shetty said that, right? So what is happening today is that public sector bank has invested heavily into digital technologies, and they have caught up with the gap which they had in terms of customer centricity. So one part that is playing. Obviously, that is something which had to happen.
Yeah.
Second part is also NBFCs also have found new ways. I mean, I know personally L&T and Sudipto's team is doing a wonderful job on, using surrogate data, using various kind of methodologies. So basically, the arbitrage of this, the capital, cost of capital, etc., can be abridged by basically using a lot of technology, and we also play a certain part from CRIF in helping these institutions, and we work with private sector also. It's not that we are not working, right? So I think it's now becoming a level playing field. Now,
In some ways.
Yeah, so level playing field is between cost of capital, information, digital tools and technologies, and risk appetite. Now, question is that who wants to play in what way? Okay. So I would say private sector banks have their own means to do fantastic business, and I'm sure they are doing it in their own way. But at some point of time, probably there are others also who are leveraging the other things and coming in the field and playing it, right? And that is what is making a difference, yeah. That's my thought. Maybe others would have other opinions on that, yeah.
Well, let me get to other points, because we may not cover, we may not be able to cover all the, important takeaways from the report. Madhu, I wanted to ask you about this higher ticket loans finding more takers and small ticket loans falling. That is one of the trends. Is that what you also experienced, and what does that tell you? This will continue? Is it a good trend?
In the smaller ticket loans, you can classify it as either unsecured personal loans, or what we call it as a buy now pay later, or BNPL is another format of a smaller ticket loan. And let's say these are all categorized like less than 1 lakh or less than 50,000. That's the categorization what I'm talking about. And more than 1 lakh is something like a higher ticket loans, right? So yes, I think what was happening with the small ticket loans, which was also pointed out by the regulator and many other reports, was there was an over leveraging that was happening. For example, if a customer is requiring about, like, let's say ultimately requires about a lakh rupee loan, but each of the smaller lenders or a small ticket loan lenders were giving, let's say, about like 20,000, then this borrower would go to 5 other people and then borrow that 20 each from everyone, but still he would make up for his requirement. So this kind of a behavior had led to a lot of over leveraging, and therefore his stress on payment of the EMIs on every month was increasing for them. And this is one trend what we had seen that, right? So what happens with the shift towards a higher ticket loan is that his EMI is spread out for a little longer period, and therefore the stress on every month becomes lower, and therefore his requirement is met, but he's going to be much more stabler in terms of his behavior towards credit. This is one factor what we really noticed, and then there has been a shift in terms of from even individually from our own company itself in changing that strategy towards looking for fulfilling the complete need of the borrower versus just a short-term loan, which requires very lesser time and lesser data, but we would ask for more data and then fulfill his complete requirements. Yes.
Fair enough. Sudipto, now to come to you. NBFCs have absolutely expanded their consumer durable loan portfolio. More generally, how are you looking at NBFCs in the current scenario? The cost of capital is clearly falling. So are you going to see a burst in any specific vertical of growth, you think, MSMEs or any of them?
Unsecured loans will grow in NBFC this year. There's the first place of growth, because the fact is that the systemic risks which had built in personal loans has dissipated to a large extent, and the leading indicators are all positive. Yeah, there might be still short-term residual risk that might be keep on flowing and might find its way into P&Ls. But I do believe that from the second half of this year, we will see we are already seeing a reasonable uptick in growth of personal loans as well as unsecured business loans, and we will see that sort of gathering pace in H2. There is one sector of NBFC, which is the NBFC MFIs and NBFCs like us, which are also present in the microfinance segment. I think we'll continue to see cautiousness for at least the next 2 quarters till the asset quality crisis in the microfinance sector dissipates. I do expect that the microfinance sector will also come back into reasonable growth in about Q3 or Q4 of this year, depending upon the institutions and their risk positioning at this point in time. I do also believe that MSME overall will see very strong growth going forward, because given the sort of the front-ending of the rate reduction by the Reserve Bank of India and the rate transmission that we expect to happen over the next couple of months, we do believe that there will be a lot of credit available to, and the government and the Reserve Bank of India also wants to step up on credit, especially to the MSME sector.
Kanika, just to wind up, a last word from the economist. How do you see credit growth itself this year for banks? I mean, banks and NBFCs. It is one thing for the economy to grow, but a lot of corporates have retained profits. And if I remember, I think I'm one person who has seen the previous cycle. From 2000 to 2004, although the Reserve Bank cut rates, credit offtake did not grow because people had retained earnings. How do you see credit offtake this year? Will it be 10%? Will it go to towards 13, 14%?
So let that 3 points. First and foremost, credit offtake typically is preceded by recovery in GDP growth. And now GDP growth recovery on monetary policy transmission typically takes 3 quarters.
Okay.
But in an uncertain world that we are living in, geopolitical trade tensions, it may stretch up to 4 to 5 quarters. So we think that last year credit growth ended at 11%. Previous year, 16% adjusted for base effect. This year, it will align with nominal GDP growth and maybe closer to 9.5% to 10% for the banking system. Just one more point on retained earnings that you said. Yes, cash surplus is a factor, but it's also the net capex growth that we see in the system, which is coming down. And I'll just give one more data. April to May 2025 sectoral deployment of credit is out by RBI. The accretion in credit is only 45,000 crores, close to 50,000 crores.
Okay.
Last year, despite it being an election year, the credit accretion in April to May was 3.5 lakh crores.
Ooh, okay.
So it's not just the growth coming down from 11 to 9% March to May. It's the credit accretion in 2 months also that's dramatically slowed on geopolitical tensions, which is why we see credit aligning closer to nominal GDP growth, credit deposit wedge also siphoning out. And in terms of sectors also, we think MSME will be the key driver, which has been the shocking point for me from the report that the originations are coming down, where government guarantee scheme is giving a buffer.
Okay.
Thanks.
Thank you very much. This is an extremely rich report, which has been rendered even richer by the points that all of you have brought to bear on the, on the trends noticed. So it is going to be a good year of growth, but credit growth may be a bit of a, may lag a bit because of retained earnings, because of uncertainty of the investment climate, given the global uncertainties. But quality of credit, expected to improve in MFIs as well. MSMEs likely to get a look in. That's a positive as well for the economy. Thank you very much, Sachin, Seth, for coming over, Madhu, Kanika and Sudipto, for enriching our understanding of the credit atmosphere and the ecosystem.
CRIF presents How India Lends in association with CNBC-TV18.